If I'm a co-host, I can record.
There we go.
Got it. Good call. Let's see.
And here everybody comes.
Hello.
Hello, everyone.
Hello, everyone.
Hello.
Hello.
There we go.
They're coming in. Welcome.
Got a nice crowd here today, Adrian.
Certainly do. We always do.
Is anybody out there cracking a nice coffee?
Dogs are barking.
I think we want to make sure that we mute all the participants. You
Well,
don't.
yeah, after everybody says hello.
Wealth management.
Everybody coming in?
Seattle. We got some West Coast folk.
Well, it's not that early, Brian. On the West Coast right now, it is
Oh, you can watch it here.
10 a.m. Yeah, I see some head shaking. Yeah, 10 a.m. Not too bad. I see an awful lot of familiar faces. So, Brian, you want to kick it off?
Perfect. Well,
Adrian, how come I'm black?
welcome everybody to our first edition of the 2022 financial forums. Patty, I think we can mute everyone at this point in time, otherwise we'll have some interesting background noise the whole time. Let's see if we. Well, welcome today to one and all. You guys all know my co-host Adrian Leeds of the Adrian Leeds Group. Who can help you with all of your real estate needs, big or small. So why don't we start with introducing you, Adrian.
I'm sorry, Brian. What'd you say? We have some background noise a little bit, so I guess.
Mute me. Let's see.
Okay, there we go.
Now we should be good. Perfect.
Okay, great.
Much easier to hear everyone. Say hello to everyone, Adrian.
Well, hello everyone, and to Brian and the rest of our team and everybody who's out there. This is the first of our 4 quarterly financial forums that we're going to be holding this year. And today we're talking about taxes. Everybody wants to talk about taxes. We have 2 amazing experts with us who will introduce themselves a little bit down the road. But one is Jonathan Hadida, who's a tax attorney, and Benjamin Pik, who is a CPA and an expert comptable. They're both fantastic on this issue. Brian's gonna, I think, open up this presentation with some general information, and then we can move on to details. I'm really just here to comment and answer some questions and make sure that we're, covering all of our bases. So, Brian, I'll let you take it away.
Beautiful. Thank you, Adrian. Wonderful to see everybody. Wonderful to see Benjamin, Jonathan, 2 of our closest friends when it comes to tax issues and tax problems. The main thing we're going to want to try to accomplish today is to make sure that any of you that haven't gotten to France don't make any of those key mistakes that come into place. Ben has a background from both French universities and Canadian universities, and essentially can help on all those deep French issues. Benjamin Pik is also part of AARO, if I'm correct, Ben.
Okay.
Are you the secretary? What's your role over there with AARO? And tell us a little bit about AARO.
I'm just a tax expert with them. I'm sorry for my French accent. If you don't know me, I have a strong French accent. I'm working with Aero, and I'm the tax expert on all the French and US tax issue, mostly on the French side, and I'm also working on the business side for every company who wants to move to France, hiring people on all the accountings and all the payrolls issues that might have in France. I'm also helping companies on the business side.
Brilliant. And always good help. I know we've worked on several cases together and always had fun with those. So we have Ben that's going to concentrate more on the French side of things, and then Jonathan is going to help us on the US side of things. How do we keep things as compliant as possible on the US side to avoid those issues and some of those acronyms that we hate? Another Canadian linkage, but we're not gonna dwell on that too much, Jonathan. We won't.
We only burnt down the White House twice.
But what we were commenting about before this was that Canada has 1 gold medal and the United States don't have any. So that put me into place for this call. Jonathan's a good friend of ours. He's made his way around from Belgium at Deloitte.
Yep.
And now he's made it over to Switzerland, where he has his own firm that concentrates on Americans in France. So give us a little bit of.
Well, thank you all so much for joining. I'm really pleased to see in the chat people from Albuquerque, and of course my favorite city of Tucson, which, you know, if you ask people at ASU, they always go for fun. But anyways, John. Hadida, I'm the owner and founder of Hadida Tax Advisors. I have previously worked in Belgium. I have previously worked in France, Switzerland, India, the US, and Canada. So I basically am an expat just like everybody else here on this call, because expats are the way to go. It's more fun. It's more fun to be around the world, you know, learning new things, and to wake up at midnight to watch the Super Bowl. Hey, you know, there's no watching the Super Bowl at 2 o'clock in the afternoon, 3 in the afternoon is not the way to go. Midnight's where it's at. So I'm really pleased to be on the call today. Hopefully we can answer any questions you guys have with regards to moving to France. And as Adrian says, you know, come on down. She'll send you a beret so you guys can be purely local. And we're looking forward to having y'all.
I'd like to just make a comment, and that is, first of all, we are recording this, and so it can be replayed later. So if you don't want to, you know, hassle taking notes, you don't need to. And if you open up your chat box, you can put your questions. Please put them to everyone. Patty Stadoskis, who's here, you maybe wave, Patty, so everybody can see where you are. She's going to be monitoring that, and we're going to try to answer a lot of your questions, so you can put your questions in the chat. Okay?
Brilliant. Thank you, Adrian. Why don't we dig right in? And I'll put this out to both Ben and Jonathan. Why for Americans is France such a great country to move to from a tax perspective?
I'll let Benjamin start.
So why don't you
so why is France a great country besides the baguettes and all that fun stuff? It is from a tax perspective. At the end of the day, as an American, you're going to pay taxes on a worldwide basis, irrespective of where you live. So you're going to pay taxes in the US, irrespective if you live in France, if you live in Italy, or if you live anywhere. Now, if you come to France as a retiree, you're going to get all the benefits of France without the main drawback, which is the social taxes and the income taxes. The French-US tax treaty is designed in such a way to help you minimize your French taxes. So if you have if you're a US citizen, that's important, a US citizen who's got investment income in the US, investment, interest, dividends, capital gains, real estate, that is all going to be taxed only in the US. France is going to give you a deemed tax credit. So basically, you're going to come, France is going to give you the healthcare, France is going to give you all the nice, fun things of France while not taxing you, provided you structure yourself in the correct way. And that's something important that, you know, Brian's firm will help with investments, making sure you don't fall into certain traps, such as PFIX, which is something I'm sure we'll talk about at a certain point, is key. But yeah, France is a great place for an American retiree. And as a US taxpayer, if you're coming over to work here, you'll wind up paying taxes, but you won't pay double tax. So you'll pay generally no tax in the US. So again, France, you'll have the benefit of having that on your side.
Yeah. For any income you might have, there is a tax treaty on that. There is no surprise. You're not paying double tax on the same source of income. So like, let's say, like Jonathan said, if you have investments in the US or rental income in the US, you will only pay in tax in the US. That doesn't mean that you don't need to declare that income in France. There is still a declaration to make in France, but you're not paying tax on that. So it's a very good, actually a good thing on the tax regime between France and the US.
I like those words. I get that question quite often. Do I have to declare this in France or the United States? And the answer is always
Yes.
Yes.
both.
Yes.
Yes, you have to declare everything. It's where you pay it, the tax. That's the important question, not where you declare it.
Actually, a very important thing, if you're not a French tax resident, it's not like in the US. In the US, if you're a US citizen, if you have the US passport or the green card, you need to declare your worldwide income in the US. But in France, if you're not a French resident, or if you don't have a French source of income, you don't need to do a declaration in France. So let's say you come to France only for a few months, just to visit, or just because you have a property in France and you're coming down the south in France during the summer, you don't need to do a declaration in France. But each situation is different, and each situation is to be appraised by a professional to make sure if you need to do a declaration in France or not.
Benjamin, would you please explain tax residency, the 183-day tax rule? Because I find that a lot of our clients get real confused between residency and tax residency because they are two completely different things.
Yeah. So there is basically few reasons to make you a French tax resident, and the 183 days, it's only one of the reasons. If you permanently decide to move to France, even if you spend less than 193 days, you can still be considered a French tax resident. The idea behind the residency is really, are you planning to move permanently are you permanent in France or not? If you, let's say your family is in France, or you have the center of interest or your economic interests are in France, even if you spend less than 183 days in France, you're a French tax resident, which means you need to do a French tax declaration. If you don't really know, for example, you working between France and the US, or you have investments in the US, investments in France, you don't really know where everything is, if you are more French residents or US tax residents, the 183 days, it's one of the options to check your residency. If you're more than 183 days in France, there is high chance that you are considered as a French tax resident.
And
Okay.
just to add, in terms of residency, sometimes you might want to file in France, even if you have less than 183 days. So for example, if you're looking to have a five-year long stay visa, or a 10-year long stay visa, or citizenship, you might want to get into the tax system earlier. The sooner you're in the tax system, you may be able to get your residency cards or your citizenship quicker.
Jonathan, that's a really good point. That, because it's not just about the money. It's really about working towards that goal of being considered a resident so that you get your 10-year card earlier.
Yeah.
Or citizenship, which you'd have to show tax returns.
Exactly. So getting in the system sooner sometimes makes better sense. And again, that's something that Benjamin and I can work with you on determining whether or not it makes sense for you to file. And it's important to ask ahead of time. I like clients. I have a couple of clients who are coming over. They basically send us an email saying, we're going to move in September 2022. What do we do? Are we going to file in France? The answer is maybe, until we go through your facts and circumstances.
Especially most of the time, there are no tax to pay in France. If you have only US source of income and you just move to France and you have no source of French income, with the tax regime, you're not going to pay tax in France. So it's better to file a French tax returns. You're not going to pay tax anyways, and you will be in the system. So it's a win-win situation. Yeah.
It starts to sound like Benjamin's trying to paint himself out of getting out of this webinar early by saying there's not much to it. Don't worry, we'll bring you back into this very quickly. But to summarize, that basically means that France is one of the most beautiful places to retire from a tax perspective, because your tax will be due on the US front, but there might be times that you want to declare early. So if we concentrate a little bit more on that US front, Jonathan, what are these two systems of the credit system and the foreign earned income exclusion, the FEIE system?
Great.
When
would you use each? So the foreign earned income exclusion and the foreign tax credits are two mechanisms that the US has put in place in order to avoid double tax for US individuals working in France. So the way the foreign earned income exclusion works is that, first and foremost, You have to meet 2 residency-based tests. Bona fide residence, which means you have to be a full resident for a full calendar year in France, or the physical presence test, which means you have to be 330 days in a 365-day period in France. Provided you meet those 2 tests, you can exclude the first 108,000 and change in 2021, 112,000 in 2022. Okay, so basically, if you earn $95,000, the equivalent, let's say you're 90,000 euro, which is now about $100,000, you can theoretically exclude that all from your U.S. tax return and basically pay no income tax on the U.S. side. Okay, so that's the foreign earned income exclusion. So the foreign earned income exclusion allows you to exclude straight off the top the first $112,000 of tax of income straight off the top, earned income. Okay, that's important. It's not pension income, it's not interest and dividends, it's your salaried income. Now,
But of course, you're paying the tax on that on the French side.
yes, you're paying the tax on that on the French side. Now, when you pay the tax on the French side, you also have the credit system, the foreign tax credit system. So the foreign tax credit system, what that does is, in order to alleviate double tax, you basically have the foreign tax credits, which are basically, you will basically can use the French taxes to credit against the US tax. So let's say your French taxes are 30,000 and your total US tax on that is 25. You can use, the US will give you a credit for the taxes paid to France, equal to the US taxes. So if in France, the taxes are usually higher, therefore you can get a credit equal to the US taxes and thereby reduce your US taxes to nothing. Now, there's an interplay to play between the foreign tax credits and the foreign earned income exclusion. The reason there's an interplay is that you can't double dip. So if you take the foreign earned income exclusion, the US reduces the foreign tax credits available to you equal to the foreign earned income exclusion. So for example, let's say you have $100,000 of income tax of income, you exclude it all under the foreign earned income exclusion. That would thereby, you would exclude all your taxes, you'd pay no tax in the US, you would also offset all your foreign tax credit. So basically, if you have $20,000 of foreign tax credit potentially available to you, the US will reduce it by 20,000, equal you to 0. Okay. Now, why is that important? That's important because at the end of the day, you're still going to wind up paying no tax under this example that I've given. Well, it's important because in France, there are certain payments that are tax-free. So when you work in France and you have a rupture conventionnelle, that's a tax-free payment to a certain extent in France. So you may actually need to have a foreign tax credit to offset it. So there's an interplay between the foreign earned income exclusion and the foreign tax credit system that we like to do. And basically we look at that on every year's tax return for our clients to ensure that they're using the right system to avoid double tax.
So John, do you have to use all those credits this year in this tax?
No. So basically the credits, thanks for asking. So basically the credits. So let's say again, you pay $30,000 of tax to France. You have $25,000 of US tax. That's a $5,000 under, you basically have $5,000 more taxes paid to France. That additional $5,000 will carry forward for 10 years. So there is a chance if you are later in your career or you want to, roll up this foreign tax credit, you can roll this up for 10 years and thereby, eventually, if you ever have a rupture conventionnelle or any some similar tax payments that are tax-free in France, use the excess foreign tax credits then.
Brilliant. And so this could work really well for, say, a foreign pension that might not be recognized so well in the double taxation treaty. Yeah.
But again, French pensions are not taxable in the U.S. We generally, under Article 18 of the treaty, we generally don't report French pensions in the U.S. So there's a big advantage again there for working in France. You don't have to pay. You wind up paying taxes on your pension only in France, not in the U.S.
But we could have a foreign pension from another country. That
yes, of course. Sorry, yes, of course. Now, where I do see it a lot though in France is the rupture conventionnelle. Because again, France being what France is with all the social taxes, when you leave an employer, severance payments are mandatory, almost pretty much mandatory, and they are pretty much tax-free up to a certain level that Benjamin could fill in for me, but it's in the 100,000-ish range. So that's tax-free money. So having extra foreign tax credits will be beneficial in that case. But yes, having foreign pensions from other countries are also something that's very beneficial.
Perfect.
Wow.
Sorry, go ahead, Adrian.
Just maybe one important thing to add, it's the consistency of what you're showing on your tax return. So if you're using the foreign earned income exclusion or the foreign tax credits, it needs to be consistent with what you're showing in France. And actually, we have one client who just was playing in both sides, taking the foreign tax credits in the US on not declaring in France that he was a French tax resident. So it's very important that if you want to use the foreign earned income exclusion in the US, you need to, in exchange, do a proper tax return in France to make sure you're consistent in what you're saying to the IRS in the US is consistent with what you're saying to the French tax system in France.
That, of course, that's only if you get audited.
Yeah. Yeah.
We'll edit that part out for the playback.
I'm just saying that there's reality here, and that's in order that you don't have any issues when and if you are audited. But you might be more likely to be audited by the French system than by the US.
Yeah. There's basically, my rule of thumb is if you come to France and you're here 5 years and you don't get one notice from the French tax authorities, you've been living right. You've been doing something. You're friends with some higher deity that's avoiding that, because France will give you notices, especially as Americans coming abroad with the foreign income. There's not every tax office has the sophistication in France with foreign elements, so you'll probably get noticed, but again, no, not an issue at all, because we can handle that.
Jonathan, what we have witnessed, however, is that for our clients who have come over as retirees, right? They get their visa as retirees, and they claim they're not going to be working in France, and therefore they're going to be turning in tax returns that have a 0 result. The tax authorities don't really care about these people. I mean, because in all honesty, they know they're not paying any tax. So why should they be chasing them down?
Exactly.
And I do know, and this is just the reality side of things, okay? I do know tons of people who have been here many, many years on visitor visas that get renewed every year, who have never turned in a tax return and have never been contacted by the French tax authorities. I'm not suggesting it. I'm just saying that I know that that's the truth.
Technically, they should be filing, and that's all I can say about that.
Yeah, of course, technically they should be filed. It's just that, I mean, in all honesty, the tax authorities aren't really concerned with people who are coming here as retirees. So the risk, in terms of if you're looking at life as a risk, the risk is very low.
Yeah. Adrian, there is one obligation in France. Even if you have no French income or no tax payable in France, there is still obligation for tax resident people. So if you're living in France for 5 years and you didn't report any income in the US, you still need to report your foreign bank accounts abroad. It's like the FBAR in the US.
Oh, right.
The same thing in France.
Mm-hmm.
And there is high penalties if you don't do that. So, I mean, let's take an example of someone who's coming to France, have only French source of income, so technically not paying tax in the US. If he's not declaring the foreign bank accounts he holds in the US, I think there is a penalties of 1,500 euros per year per bank accounts.
1,500?
Yes.
Okay, so that's quite a bit less than the US requirement, which is $10,000 value.
Yeah.
Yeah, but still, it's not nothing.
No, that's right. In fact, no, it's even more important because it's such a low amount.
Yeah. And it's such a low threshold in France. At the end of the day, all you have to do is report the bank account. You don't even have to spend the time finding the maximum balance. It's literally just tell the French authorities, these are the bank accounts you have, and that's that. So there's no reason not to do it. And there's no reason, technically there's no reason not to file a French tax return, because you won't pay tax. It's not a big risk to, it's a bigger risk not to file than to file.
And if you have rental income on a property, for instance, then for sure you would want to file that tax returns. Absolutely.
Yeah.
Brian, you have another question?
We have tons of questions, and keep bringing these questions in. We've got our few questions that we're going to get through here, and then we're going to get to all of yours. So please keep those coming. Lots of questions coming in about retirement accounts. If we're talking about retirees in America, they probably have 401ks, 403bs, all the different acronyms over there, simple steps, et cetera, et cetera. how do the French authorities look at those when you take distributions?
Want me to? Okay, so I think Jonathan mentioned it earlier. It's Article 18 of the tax treaty between France and the US, and it's only going to be taxed in the country where the money is coming from. So technically, the US. So if you're taking any money from your IRA, it's going to be taxed in the US, and it's not going to be taxed in France. Again, it's not taxed in France, but you need to declare it in France.
Perfect. So does that mean that a Roth IRA, which would be tax-free in the United States, would not be taxable in France as well?
Yeah. No matter how much tax you pay in the US, that's the magic of the tax treaty. No matter how much tax you pay in the US, there is no tax on that in France. This question is the same for example, for the rental income. The rental income is heavy tax in France on less tax in the US. You can have massive rental income in the US. You're going to pay low tax on that in the US, and you're not going to pay anything in France, even if the rates are higher than in the US. So same thing with the pension, with dividends. It's taxed in the US. It's taxable in the US. So no matter if you pay tax or low tax in the US, it's not taxable in France.
You know, I'm going to take one key word out of that Benjamin said, and I'm going to redub this whole webinar, the magic of the tax treaty.
Yeah.
That is what it's going to be called from now on. And there was a question whether there was going to be a replay. If you put Dunhill Financial on YouTube, you'll see it posted up come tomorrow. And Benjamin will be quoted as having the magic of the tax treaty. I've never heard it put that way, but I'm always going to steal that from you from now on, Benjamin. Thank you. So Jonathan, we just talked about distributions in France. Ben just took all the good news there. So now you have to one up it with even better news. If you're over in France and you're working, can you make IRA contributions?
Of course, you can. So
they're getting really competitive, Adrian, aren't they?
So you can now. Whether or not you want to, that's an open question. And so, can you make IRA contributions? Yes. Now, we talked earlier about the foreign earned income exclusion and the foreign tax credit. So one of the things you want to take note of when you're looking at the foreign earned income exclusion versus foreign tax credit is if you exclude all your income using the foreign earned income exclusion and have zero income left, you technically cannot contribute to an IRA because you have to have income left over. So again, for the gentleman or ma'am who's got $100,000 of salary, the $100,000 exclusion, they cannot contribute to a Roth IRA if we use the foreign earned income exclusion. Now, if we use the foreign tax credit method, they can do an IRA contribution, okay, and thereby save for retirement and reduce their taxes. Now, there is an open question from a tax perspective as to whether it's a good idea to do an IRA contribution while you're abroad, because at the end of the day, you're not really deferring any taxes, as in France. Again, because in France, you got to remember, you're going to pay probably more tax to France than you will to the US. Between the income tax and CSG, CRDS, you will generally wind up paying more tax to France. So therefore, is it a good idea to make an IRA contribution while in France? From a tax perspective, debatable. Okay, so again, I'm purely tax, not investment, not retirement perspective, purely tax.
Okay, but Jonathan, that's only for people who are actually working in France.
Yes, ma'am. Only people
not
who
for
working.
retirees. We're talking exactly.
Retirees cannot because they've got no earned income. But people who are working, they can still make IRA contributions. They can still make Roth IRA contributions. Again, that's something that we want to know upfront before we file your tax return. Because if you're planning to make IRA contributions next year or the year after, we may want to then put you on the foreign tax credit method, as opposed to the foreign earned income exclusion. Okay. Does that answer your question, Brian?
Yeah, and I'm going to one up it, and I'm going to I'm going to ask you: Is there ever an opportunity to make a Roth conversion from a traditional IRA when you're an expat?
Oh, Brian, great question. These are the questions I love. Is there a way to make a Roth conversion? Absolutely. Roth conversions, I love Roth conversions. I love Roth conversions because you're crystallizing your taxes today and you're going to use it. I'm older than I was before, but I still have a little ways away between now and 59 and a half. So if I did a Roth conversion today, my little ways away, theoretically, using a firm like Dunhill Financial, my growth would hopefully be, tenfold by the time I retire. So thereby, I would crystallize my taxes today, pay no taxes when I retire. So yes, a Roth conversion makes perfect sense because you got to remember, you are going to be at a low taxes in the US because of the fact you have the foreign tax credit and the foreign earned income exclusion. So doing a Roth conversion makes perfect sense. And that's something that I work with a lot of clients on figuring out whether or not it makes sense. And to be honest with you, how much makes sense each year, because you want to make sure you stay within the tax brackets, the correct tax brackets. Because in France, as Benjamin said, we don't have to pay tax in France. We have to pay tax in the US, so we want to play the tax bracket game. And that's something that, working with a proper tax professional is imperative.
I love how excited you got.
It's taxes, it's great fun.
I've seen some of his spreadsheets on these. He gets just as excited in the spreadsheets as anything else. So if you didn't understand what he was going on about, just email him, and Jonathan will sort you out on that piece. I feel like this is a loaded question for all three of you. Let's talk real estate and taxes, purchasing and renting in France.
Okay, what aspect do you want to talk about?
Oh, let's go on every single person. Let's start with buying and selling a property more short term instead of long term, and what is defined as short term versus long term.
Okay, well, do you want me to just talk about the taxes you pay when you purchase a property?
Yeah, let's start with that.
Okay, so there are notarial taxes and fees that are paid when you purchase, which it's a one-time shot. It amounts to about 7 to 7.5% of the price of the property, but the tax portion of that is a little over 5%. And that's all that you pay on the taxation of the purchase. And then there are annual property taxes, which are taxe d'habitation and taxe foncière. The taxe foncière is your annual property tax, which is unbelievably low compared to the United States, about 1/10 of what taxes are in the US on property. And the other is taxe d'habitation, which is only paid, it's not paid by full-time residents, but it's now paid only by, if it's a secondary property, they are about the same. They run, seems like it's about 0.001% of the value of the property, give or take. And you know that when you make the purchase going in. After that, there would be only taxation on the rentals. And I can let Jonathan or Benjamin address that.
Now, see, France now is a funny country when it comes to rentals, in my opinion, because there's a main distinction between furnished and unfurnished. This is not something from an American point of view we'd ever question or ever look at. Now, I jumped in, so I'll let Benjamin take it from here.
Go ahead.
But basically in France, if you're renting a furnished rental, there are different tax situations than if you have an unfurnished rental. A furnished rental, if I'm not mistaken, and Benjamin will correct me, you can take depreciation, French depreciation. You can take more expenses. Now, there are additional filing requirements. You have to file a form 2031, if I'm not mistaken.
Yeah.
If you have a furnished rental, whereas unfurnished rentals, you can generally take the normal deductions, but you cannot depreciate. So that's a big difference between the two in France. I'll let Benjamin jump in, and then I can jump in with the US side. Sorry.
No, it's exactly that. And there is one thing behind the rental income, which is important to know. It's when you sell the property in France, the more you hold the property, the less tax you're going to pay. So there is basically two types of tax you're paying when you sell a property in France. There is the income tax on the social charge of the capital of the pre-value of the capital gain you're making on a property. The more you hold the property, the more there is a tax allowance allowing you to pay less tax. So
yes, but that's only if it's not a primary residence. If it's a primary residence, there is no capital.
Yeah, exactly. I'm talking about investment rental income. What I'm saying that because it's applied even for properties that you don't have in France. So let's say you have a property in the US, an investment property in the US, and you move to France. So you can be liable to this tax in France, and they're going to take in consideration the tax you pay in the US. So if you're making a capital gain on the selling property in the US while living in France, you can be liable to this tax. But it's a complex calculation. I don't want to go into it right now. But there is some way to reduce this tax on the capital gain.
Really? Well, I love that as a segue. I'm going to skip a couple questions just because it's a nice segue. Your taxes go down the longer you own a piece of property. What happens if you hold the property too long and you accidentally pass away in France?
Oh, that's a new can of worms, inheritance tax. I think we need to do a forum only on inheritance inheritance taxes, because it's really complicated, right, guys?
Basic rule of thumb, Brian, come live in France, enjoy the baguettes, just don't die in France. Just don't. If you want to die, go back to the US, stay there for a little bit, don't die in France.
Well, no, Portugal has zero estate tax, and
Move to Portugal!
4% in Italy, and you know, there's plenty of places.
There's plenty, but just not in France, unfortunately, friends.
Planning before you get to France is the optimal thing. Adrian, do you want to talk about Société Civile Immobilier, SCIs, for just a second?
Well, I think that's another big can of worms. And the SCI, which is a French property company, means that you can put the purchase of the property in the name of this company, an SCI, and it enables you to have various owners with different share amounts. So it does help in terms of being able to bequeath the property, that's for sure, so that you can, you can have your family can own, you can give certain percentages or shares to your children, for example. And therefore, when you inherit, but this has to do with inheritance. That's why I think this is a conversation we should actually devote a complete forum to down the road, because there's too much detail here to really, sink our teeth into it.
I think we can summarize. It is great to retire in France. It is expensive to work in France, but we won't get double taxed in the United States, but it's extremely expensive to die in France. Would that be the easiest way to summarize that?
Yeah.
So yeah.
Yeah.
Well, yes, because of inheritance taxes.
Mm-hmm.
Yeah.
We've got one last acronym to jump on, and then we'll jump into all the Q&As from the wonderful audience. We've got a 4-letter acronym in PFIX. Jonathan, do you want to dig into what a PFIX is?
PFIX are the bane of a U.S. tax preparer's existence, for lack of a better word. They are absolutely atrocious. So a PFIC is a passive foreign investment company. It's a company that invests primarily in passive investments. So basically, the way I look at PFICs and I explain to clients is it's a mutual fund. A mutual fund is a company that is set up to invest in other companies, okay? A mutual fund and ETF. Now, why do we care about a mutual fund ETF? They're nice investments. They're good to have in your portfolio. Well, the US put in place these PFIC rules in order to avoid tax shelters, avoid people setting up foreign corporations to have their foreign investments. Now, unfortunately, foreign mutual funds and people like us get caught into this web because of the PFIC rules. So what is the web? The web is that punitive tax is basically the long and the short. If you hold a PFIC, so a passive foreign investment company, so a French mutual fund, a French ETF, or any foreign mutual fund, you can have, as I said, onerous French tax implications. Now, what it is you defer the income on it. Now, when you take a distribution from it, the distribution from the ETF being a dividend, or you sell it or whatnot, you'll pay tax at the highest tax rate in the US. Additionally, you'll pay interest in the US on the period of time that you've held it. So if you held it for 10 years, you will pay interest over that lifespan for 10 years. So you may wind up paying even more than the top tax rate in the US simply by holding this PFIC, okay? So what I always recommend to clients is, before investing in France or in a foreign investment, let's have a conversation to talk through, what is this investment? What is the underlying asset that you're buying? Is this actually a PFIC, or is this actually a stock? And secondarily, as much as possible, I always recommend for Americans to invest either in the States or through a US investment company or a company that understands US investments, because you do not want to wind up going to your bank, having your banker say, "Ooh la la, ça c'est magnifique, fais cet investissement." And then you wind up going, "Oh la la, Jonathan's going to charge me a fortune and the US government's coming after me." Okay. So we need to make sure that whatever you do, you don't invest in these things that will include, that will have these negative tax consequences. So, that's why, again, earlier I was telling Brian why a company like his is so important, because of the fact that if you invest through something like that or through a US investment advisor, you will not fall into the trap of PFIX, because it's a mighty hole that we really don't want you to fall into. Or if you do go into it, again, if you do go into it, you have to go into it with open eyes and clear mind, because it will have some tax complications.
Spending time with Jonathan should be spent on better things than having to learn exactly how PFIX works. I couldn't agree more. And that gives us a nice segue into Catherine's question. Catherine asks, what if your institution limits your investment choices or freezes your account when making a Roth conversion or any other investments? And I'm going to jump in and answer that. A lot of institutions are scared and don't do business in France. You might find yourself getting restricted the minute you go to France. There's firms like mine that we help you find the institutions that will work with you in France. Now, you don't necessarily have to hire a registered investment advisor like ourselves. If you have an account back in the States, the safe way to go is to make sure that if you're buying investments, you stay away from non-US exchange traded funds or SICAVs. That easy way for that is to buy individual securities and such. So if you have a French account, if you're buying individual stocks, you won't end up with any PFIX or the likes. So if you don't have an account that allows you to stay in France, just contact me. We can introduce you to our international and our US custodians that can take care of all those investment needs. Should we start on the Q&A, or did you have something to add, Jonathan?
There was a question about interest, about foreign interest, and that does not fall into a PFIC. So just to be clear, we're only talking about stock investments. So mutual funds, ETFs, and the like.
This is a great question from Kim. What if your goal is to become a dual citizen? How does this change things?
It doesn't.
Once you're American, you're stuck being American, right?
Hey.
Well, and I'm going to say this again, there's the difference between residency, call it citizenship or residency, and tax residency. Because there are an awful lot of people who carry a carte de séjour, who carry some sort of residency visa, but don't actually spend more than 183 days here, or don't have a business here, or earning income here. And so then they're no longer tax resident in France.
Yeah, but the dual citizens doesn't matter. At the end of the day, you can be a dual citizen of Ireland, you can be a dual citizen of Portugal, you can be a dual citizen of France. If you're an American citizen, A, you'll pay taxes in America, and B, you will get the wonder and joy of the tax treaty, as Benjamin called it, and basically you'll wind up not paying tax again on your U.S. investments. Keeping your investments in the U.S. will avoid double tax in France.
And that even works for the green card holder, right?
No. So it's the green card holders, unfortunately, don't benefit to the same. Unfortunately, the green card holders are not treated similarly as citizens. So it's one of my first questions I ask any new client is, you're a U.S. citizen? And I repeat the question again after a few minutes. Are you a U.S. citizen? Yes. Okay, cool. Thanks a lot for letting me know. Yeah, because green cards, unfortunately, don't get the same benefits.
Lori has a question. How should I structure my business if I want to keep them US based while living in France?
You reach out to us and we talk through your situation, because that's a big question without an easy answer, unfortunately.
The nice thing is, if you listen to our webinar last year, Ben had some wonderful points that are too long for us to go into right now, but it's on the replay from last year on YouTube. about how you can structure both a U.S. company and a French enterprise.
Jonathan, I don't find that to be a difficult question, but that's because I have a U.S. business that is U.S. based. It's a C corporation. And then, of course, I have French business that is France based, and the U.S. corporation doesn't have anything to do with France.
Mhm.
The only thing that I would have to report would be whatever income or dividends I were to take out of that U.S. corporation. Otherwise, France doesn't have anything to do with it.
Yeah, but you have to want to set up a C corporation, and then you have to go through the hoops of setting up the C corporation in the US and the like. And again, if in some cases people come over for a couple of years, if you're coming over for a year or two, we have to look at the benefits of what the best steps are for you. If you're coming over for, like you, Adrian, you're going to be here.
I'm here, right.
You're
No,
here.
but I learned the hard way because I originally had an LLC, and what I discovered through being audited was that the LLC and me, we are one and the same.
Yeah.
And so that any earnings the LLC had would be considered earnings in France. So, but the corporation, the C Corp changed that completely.
Yeah, and you know, there's a question that just came about an S Corp. An S Corp's the same thing. An LLC, a partnership, an S Corp, unfortunately, they're all flow-through entities. And again, Benjamin can answer this better than I can, but basically, from a French perspective, they should be reported on your French tax return and pay tax. Again, the advantage of the C Corp that Adrian has is that a C Corp is a separate legal entity. Ergo, it's a separate person that, you know, if Adrian didn't want to tell anybody that she had a C corporation, no one needs to know. No one would know, unless they wanted to go in and look for it. So that's why, you know, it takes a little bit of planning to ensure that you get set up in the right way.
Okay.
There is a solution for every situation. I mean, with Jonathan, we've been through many clients in that type of situations, especially with the COVID, when everyone is trying to work remotely, and someone who has a job in the US wants to come in France for a few years and continue to work in the US. There is solution for every situation.
Yeah, but again, it's one of those things that we'd like to talk through your case and your situation to better understand, you know, what you're doing and what your case is, and we can help you set yourself up in the right way for both countries and go from there.
Absolutely. You'll ask. We actually already answered this, but we'll because it's good news, we'll answer it again. What about Roth distributions? We wouldn't be paying tax on them in the U.S., but how would the French treat such distributions? Tax-free.
The magic of the tax treaty.
There we go. We're back to the magic of the tax treaty. Ben, when is the tax deadline in France to declare French taxes?
So it's a very complicated question because it's been changing for the last 3 years with the COVID. Usually it's at the end of May, beginning of June. But if you're first French tax filer, usually it's end of May. But I mean, we don't have the deadline yet, and it's going to change. It changes every time with the COVID. So the last 3 years have been different. It's not like in the US where you have a strict deadline with possible extension.
Jonathan, every answer on France is complicated.
Oh yeah, well the French tax return is incredible. It's a sprint. It's not a marathon like the US one, and it really comes down to I have no clue. When none of us have an idea. When the French government come up with the deadline, they'll tell us. And then, as Benjamin said, the last couple of years with COVID, they gave us one date. Then a few weeks later, they gave us another date, and we just went on with our days and just worked through it as best we could. But yes, no, France.
But there is no extension. There is no extension like in the US. In the US, you have few extensions, so it's good. In France, we don't have extension. If you think you're going to be late because you don't have all the information ready, or because sure, it's better to file tax returns, even the wrong tax returns, and then do an amendment. But the idea is to be on time. The time I don't know, but the idea is to be on time.
That sounds very French. The idea is to be on time. I don't know what time. Are French social charges included in the tax treaty?
Yes. All the time, it's income tax plus social charge. And by the way, this is a very important question because the way it works in France, it's not like in the US with the IRS. When we send the tax returns, I'm taking like an example of someone's coming to France with a rental income and pension in the US. So as we said during this webinar, you're not supposed to pay tax in France. The thing is, in the French tax authority, the guy who's going to process your tax returns doesn't necessarily know the tax regime. So he's seeing your tax returns and he's going to be like, okay, you get rental income in the US, you get pension in the US, I'm going to tax you in France. So don't be surprised. Every year, Jonathan can confirm, but every year we have a lot of claims to make to the French tax authority. I would say like maybe between 20 and 35% of tax returns that are wrongly processed. So don't be surprised if you get an assessment, a wrong assessment. We can claim back on its social charge plus income tax.
Brilliant. Lori, I think we can confirm that Adrian, the boss, has made the decision that we're going to be doing an entire session just on estate taxes, so we can go through.
I think we should. It's a very important topic. There's an awful lot of questions. I mean, I see one question here is, the question is, maybe it's better to rent than buy if you're intending to retire in France. And, that's a valid question but when you're renting, of course, you're not investing in your own property, and you certainly can't bequeath a rental property at all, regardless of what taxes might be paid on it. But I do think we should set this up for maybe an upcoming forum, specifically on inheritance tax. I have the problem myself personally. As you know, I've been discussing this because as a French resident, I'm going to be my one daughter will end up paying inheritance tax on every aspect of ownership, all of my properties and company and whatever else, wherever they are, if I stay in France and die in France. But quite honestly, this is where I want to be. So no offense to everyone who's out there talking about, reducing and minimizing their taxes, but there's life to consider, not just money. And we're not taking it with us to our graves anyway. So we need to just enjoy it, minimize our expenses and our taxes as best as we can, and then enjoy our lives where we want to be. That's my opinion.
Taxes isn't everything. Taxes don't wag the dog.
No, I see one question up here, for example, is whether it's better to retire to France or Portugal from a tax perspective. But I think you just have to think about where it's better to retire, and then you deal with the taxation the best you can. Because, I mean, where do you want to be? Do you want to be in France or Portugal? Forget the money.
I think that's great advice. I've got a book right on my desk called Die with Zero from Bill Perkins, which goes through that exact example. And it's a must. There's several questions on double taxation treaties between other countries like the UK and Canada. I would advise for you to reach out to Ben and Jonathan about your situations because those are going to be a little bit more in depth. Let's see.
There's a question here about, should I make a will trust before moving to France? The answer is you should not make a trust before moving to France. You should wait for Adrian, wait for the next webinar that comes out about inheritance.
Right, but France doesn't recognize the trusts.
And France has a trust filing requirement, so you need to speak to someone qualified. So Benjamin can help. Benjamin can help with that kind of question, because you don't want to come to France with a trust without knowing the implications of coming to France with a trust.
There is a specific tax declaration for the trust. If you own a foreign trust in the US, you need to declare it every year in France by mentioning all the value of your trust, and there is a specific trust form on that.
Okay. Patty, maybe you could put in the chat how these people can contact each of us, because I've seen that question in there.
And don't worry, we're going to be sending out a follow-up email to everyone with everybody's contact information and the playback so that you can look through it. I'm just looking through the rest of the questions. Are there more that the three of you want to jump in on there? Oh, the fireplace disappeared, Jonathan.
Well, someone asked for my contact information. I figured I'd move and give her my website and all that fun stuff.
Well, I have nothing on my back.
Exactly. How old is a child? Oh, but yeah.
That's a good question. How old does a child need to be in order to be an owner of a property? I don't know the answer to that.
I don't know that either.
I don't know that there is an age limit.
Yeah, I don't think there is an age. I'm not sure, but I don't think we need an age, because some kids get like shares of a property very young, like at 1 or 2 years old.
Yeah.
So they're certainly intending on owning that property for a very long time.
We had a client just purchase a property in her son's name, and I know the son was 16.
Okay, but that's not very young.
That's not
I mean,
very young, but
16
at least,
is not right.
that one, yeah. There, Jennifer just commented on that, right?
I mean, the truth is that most people who are buying property here are already a certain age because they can afford to do it, and therefore their kids are at least teenage and older.
Yeah.
So our experience hasn't really, we haven't really had kids on a deed that are much less than that 16 years old.
There's one question here about how do we know which company stocks are PFICs? I can give you a general answer. It's relatively simple. A company stock is not a PFIC. It's ETFs, mutual funds are PFICs. So if you invest in
Foreign ETFs, US ETFs are fine.
Oh yeah, sorry, apologies. Yes, that's my bad. Foreign ETFs and foreign mutual funds, let's make that more abundantly clear. Not US mutual funds. Foreign ETFs, foreign mutual funds are generally PFICs. So that's the rule of thumb. If it feels like an ETF, if it feels like a mutual fund, if it feels like a PFIC, if it smells like a PFIC, it's probably a PFIC.
I'm going to add to that a few little things on here. First of all, also on the US side, we avoid buying US mutual funds for clients because they're not MiFID compliant in Europe. Now, there is zero tax consequences for not being MiFID compliant at this point in time. But we're an extremely conservative firm, and we look at things in a conservative way. And if the US is taxing based on people owning foreign investments, one day, I guarantee you, the French, when they can find a way to tax somebody, they're going to use that as an opportunity. So I would expect them to do so. The Italians have already started doing so. So if you have US mutual funds in there, right now it's not a problem in France, but I would start to get rid of them if you can, and if it's not too costly from a tax perspective. The other thing that I would say is a lot of you will hear a lot of things about assurance vie, basically being more like a variable annuity type of structure in France. The French love it. The non-Americans community loves these things, and we'll dig right into that in our estate planning seminar because it is a great estate planning tool. If you own the typical vehicles, it will be a PFIC. If you buy,
more likely than not.
Yeah, but you can structure it to where you can buy US ETFs or individual securities in there and get your 1099, and then it won't be a PFIC. So be very careful with those, because I'd say 99% of the time they're sold as PFICs instead of non-PFICs. That being said, we have 2 minutes left. So I would like each of you to give us your final thoughts, your overly optimistic thoughts, because I think we've had the happiest crew of tax ever, which is wonderful.
Benjamin?
To start.
Start, Jonathan.
All right. So overall thoughts, France is a great place to retire. France is a great place to live in general, but France is a great place to retire from a tax perspective because, again, the magic of the tax treaty. Now, France is not a terrible place to live and work. The tax implications in France will make it such that you will pay in France, you will not pay in the US. You know, remote work, there's a question here about remote work. Remote work is a you know, you can come to France, do some remote work. You may have to pay taxes in France, may have to pay some social taxes in France. But again, is it better to sit in Côte d'Azur or in my favorite places closer to Sète? But that's just me, Adrian. Adrian's not going to be very happy. She's more Nice than Sète and Marseille. But hey, that's just different strokes for different folks. But basically, is it better to be here than to be in, the US? That's an open question that, you have to ask yourself. But I'll be honest with you, I love living here. It's absolutely fantastic. From a US tax perspective, nothing really unfortunately changes for you as a retiree. As a US worker here, you need to make sure that you get proper tax planning done and proper tax work done, generally before and also while you're here, because you do not want to fall foul. You don't want to pay double tax. Using a tax professional will help you avoid taxes. That's the overarching thing that I can help you with, is that using a tax professional will more likely to not help you avoid taxes on both sides of the coin. So that's my spiel.
An ounce of prevention is worth a pound of cure, something like that.
There you are.
Everything was said by Jonathan, so I don't really think nothing to add. Don't be afraid to move to France. Honestly, I know we have the reputation. I'm saying we because I'm French, and we have the reputation of making everything complicated. It's true. We have a strong administrative burden and everything, but it's not complicated, as Jonathan said. On the tax perspective, it's not complicated at all. Don't hesitate to take a professional advice. I think this is the best advice that we can give you tonight. Don't hesitate to take a professional advice. Even before you plan to move to France, there is a lot of questions that can be answered even a long time before, like selling properties, creating a trust, creating a will, and all the type of questions. There is a lot of solutions, a lot of options, and don't be afraid to come to visit, to live in this great country.
Well, okay, and you guys, I pay a lot of tax here in France, okay, because I'm working, I have a company, so I pay Social Security charges, but I can tell you that the bottom line is it would still cost me twice as much to live in the United States than it does in France, even with the tax burden, because it's primarily working, my earnings where I pay the tax. But when you start to consider healthcare costs, the amazing infrastructure in this country, the ability to live in certain cities without ownership of a car, property taxes that are ridiculously low. When I take into consideration all of those things, my bottom line is that it costs me half as much money to live in this country, enjoy it 10 times more, because I have all this, culture, lifestyle, everything that we have here in France versus what I had in the US. I just got back from my trip in the US. Prices are out of sight. I was living in a car society, getting in and out of my car to do anything, which, I just thought, okay, 10 days, I've had enough, I'm going home. And I wouldn't trade earning more money in the US for the lifestyle I have here. And so my advice is to consider your life before you consider your money.
But we'll still make sure that you save as much money as we can on your taxes.
Well, of course, and I depend on you guys to do that for me.
Yes, ma'am.
Benjamin, Jonathan, Adrian, I couldn't have put it any better. You guys are the best people to figure out every single part of the tax code, and Adrian, the real estate ways of France. But I do think, Jonathan, you hit the nail right on top of the head. Pre-planning will make you so much better off than trying to fix it afterwards. We tried to cover most of the major pitfalls that can affect you in bad ways. We'll continue to do that with the estate tax section, but please reach out to all of us, myself for investments, Jonathan for your US taxes, Benjamin for your French taxes, Adrian for all your real estate needs and your opinions on everything else.
And Brian, when is our next forum so that everybody can tune in?
Oh, that is a beautiful question, and we do need that. Patty, do you happen to know?
March 4th.
March 4th.
May 4th. May 4th.
May the 4th be with you.
May 4th, exactly.
Biggest dork right there.
At 7 o'clock, at 7 p.m. France time. And we are going to be talking about inheritance taxes, I imagine, right?
Sounds wonderful to me. We hope everybody enjoys the Super Bowl and let your team win. Especially, this is the most gambled upon Super Bowl ever. Over $7 billion wagered. And in the continuation, Jonathan might actually tell you how that will be taxed.
Yeah.
So
There you go.
enjoy the game.
Okay,
Thank
this
you
is a
all.
really dumb question, but who's playing?
We have the Rams that are now in LA, which throws me off, and I believe the Bengals.
Yeah.
So
Yeah. And you have Brian, Benjamin, and I who are going to be awake at, don't call us on Monday morning. Don't forget, we'll be awake watching. I'm watching French TV. I'm gonna with no sound, but midnight 12:30 on Sunday. I'll be watching TV. So good fun.
Not me.
You're smart. You're smarter than us. That's for sure.
Thank you, everyone. Thank you, everyone, for being here. We look forward to having you at the next forum on May 4th. And Brian, as always, wonderful. Thank you. Au revoir.
Thank
have a
you.
good one.
Thank you, everyone.